When people talk about investing, they often imagine charts, stock tickers, and market news flashing across screens. But long before modern technology shaped the way markets look today, the foundation of wealth building rested on four simple pillars: equities, fixed income, real estate, and commodities. These are known as the four primary asset classes. And for over a century, they have defined how wealth is created, protected, multiplied, and sometimes lost. To understand the financial world, past, present, or future, you must begin by understanding these four categories. Each one represents not just an investment type, but a philosophy, a belief about what humans will value, how economies grow, and how societies function. Imagine a giant financial ecosystem. These four asset classes are the roots, branches, and leaves of that ecosystem. Stocks are the growth engine, bonds the stabilizer, real estate the sheltering backbone, and commodities, the raw materials that civilization is built on. For students, researchers, and anyone trying to decode financial history, the key is recognizing how these four interact, not just within a portfolio, but within the global economy itself. Let's start with equities, commonly known as stocks. Buying a stock means owning a piece of a company, not a metaphorical symbol, but a literal slice of ownership. When you hold a share of Apple, you own a fraction of its future profits, innovations, risks, and successes. Equities, historically, have been the strongest engine of long-term wealth creation. The logic behind this is straightforward. Companies grow as economies grow. They innovate, hire people, enter new markets, and build products that didn't exist before. That growth translates into earnings, and earnings, slowly or explosively, translate into value for shareholders. But equities do more than rise. They also fall, sometimes dramatically. The stock market is where optimism and fear collide. It is the most reactive of the four asset classes, responding almost instantly to political events, technological breakthroughs, economic data, wars, pandemics, and human psychology. While equities offer the highest long-term returns, they also subject investors to the greatest emotional and financial turbulence. In financial history, stocks have been the asset class of innovation, ambition, and progress, but also the asset class of bubbles, crashes, and recovery cycles. Now contrast this with fixed income or bonds. If equities represent owning part of a company, bonds represent lending money to governments, corporations, and institutions. Instead of sharing in profits, bondholders receive interest. Instead of volatility tied to emotion, they experience movements tied to interest rates, inflation expectations, and creditworthiness. Historically, bonds have been the stabilizing force in portfolios. They don't rise as quickly as stocks, but they don't fall as sharply either. For centuries, governments have relied on bonds to fund wars, infrastructure, and nation building. Corporations use them to expand, refinance, or survive downturns. From a historical standpoint, bonds have played a dual role. They have offered investors safety during crises and income during normal times. But bonds are not risk-free. Governments have defaulted. Companies have collapsed. Inflation has eroded purchasing power. Interest rate spikes have crushed bond prices. And yet, despite these risks, bonds remain essential because they represent something deeper than mere returns. They represent the human need for security and predictability. Then there is real estate, more personal, more tangible, and emotionally charged than stocks or bonds. Real estate is the asset class people interact with daily. It is land, buildings, homes, farmland, factories, and infrastructure. Historically, real estate has served two functions. It provides shelter and it produces income. Long before stock exchanges existed, land ownership signified wealth, power, and social status. Today, the dynamics remain similar. Real estate generates rent, appreciates over time, and serves as collateral for economic expansion. Real estate responds to different forces than stocks or bonds. Population growth, urbanization, housing shortages, zoning laws, and mortgage rates shape its behavior. During inflationary periods, real estate often preserves value. During credit booms, it surges. During recessions, it slows or crashes. But across centuries and continents, real estate remains one of the most enduring forms of wealth. Finally, we arrive at commodities, the oldest asset class in human history. Before digital markets, before stock exchanges, before modern banking systems, the world traded in the essentials: gold, silver, grain, livestock, oil, copper, timber, and other resources. Commodities are the raw materials of civilization. They do not generate income or produce innovation. Instead, they hold intrinsic value because societies cannot function without them. Commodities behave differently from stocks, bonds, or real estate. They respond heavily to supply and demand imbalances, geopolitical tension, weather patterns, technological changes in extraction, and global industrial activity. Gold is sought during uncertainty. Oil reacts to war and energy policies. Agricultural goods respond to droughts, floods, and global consumption patterns. Commodities are unpredictable, cyclical, and often volatile, but they serve as powerful tools for inflation protection and portfolio diversification. Understanding these four asset classes individually is only the first step. The deeper insight comes from understanding why they exist in the first place. Human societies need businesses, and businesses need capital. This gives rise to equities. Governments and institutions need predictable funding, thus bonds. People need places to live, work, and build. Real estate emerges, and civilization itself needs raw materials, which create commodities. These asset classes form the backbone of modern financial markets, but they also tell the story of human civilization. Every economic boom, every recession, every technological leap, and every global crisis affects these four categories in some way. A century of data shows that each asset class has strengths and weaknesses, and none dominates in all environments. Stocks reward innovation but punish panic. Bonds reward stability but suffer from inflation. Real estate rewards long-term demographic growth but suffers from debt cycles. Commodities reward scarcity and geopolitical tension but suffer when global demand falls. This is why studying them is not simply an investment exercise. It is a historical investigation. Looking at how these assets behave is like watching the heartbeat of the global economy. When equities rise sharply, it often signals technological or economic optimism. When bonds surge, it often reflects fear, recession, or falling interest rates. When real estate prices climb rapidly, it may reveal credit expansion or demographic pressure. When commodities spike, inflation or geopolitical uncertainty may be looming. For students, analysts, or anyone trying to understand how the world works, these patterns are invaluable. You don't have to be an investor to benefit from knowing why these assets exist. They shape housing affordability, government borrowing costs, food prices, fuel costs, and the pace of economic development. The four asset classes are intertwined with daily life: your rent, your groceries, your job, your future. They represent not just financial categories, but entire histories of human behavior. Equities show our capacity for innovation. Bonds show our need for reliability. Real estate shows our demand for space and settlement. Commodities show our dependence on Earth's resources. Each one reflects a fundamental truth about society, and each carries lessons stretching back more than a century. Understanding them is not about predicting markets. It is about recognizing the forces that shape modern civilization. Only then can you appreciate how history, economics, psychology, and policy weave together to create the financial world we navigate today. Financial markets are often portrayed as chaotic, unpredictable, and driven by the whims of investors. But when you step back and observe history over decades and centuries, a pattern emerges. The four major asset classes, equities, fixed income, real estate, and commodities, each exhibit distinct behaviors in response to economic, political, and social forces. By analyzing historical data, we gain a deeper understanding of how markets move, why some assets outperform others during specific eras, and how these patterns provide lessons for students, historians, and future investors alike. To understand a century of market behavior, it is essential to examine key historical periods, the drivers of each era, and how each asset class responded. Let us start at the beginning of the 20th century and move chronologically. The early 1900s, industrialization and market expansion. The early 1900s marked a period of rapid industrial growth in the United States and Europe. The second industrial revolution had matured, introducing steel, electricity, railroads, and chemical innovations. Stock markets were still relatively small and illiquid by today's standards, but equities began to reflect the explosive growth of industrial firms. Equities, stocks in industries like railroads, steel, and energy provided investors with strong long-term growth, though volatility was high. Market crashes were frequent due to speculative booms and limited regulation. For example, railroad stocks surged as the U.S. expanded westward, creating enormous wealth for early investors. Government bonds were stable but offered modest returns. Corporate bonds grew in popularity as firms sought to finance expansion. However, defaults were not uncommon, especially during periods of financial panic. Real estate urbanization fueled demand for residential and commercial property. Cities like New York, London, and Chicago experienced rapid growth. Property values generally increased in urban centers but remained illiquid, making real estate a slow-moving asset class. Commodities. The agricultural sector remained dominant for commodities. Wheat, cotton, and coal were major drivers of economic activity. Prices fluctuated based on harvest, weather, and international trade. Industrial metals like steel and copper also gained prominence. Key lesson: the early 1900s illustrated that industrial growth benefits equities and commodities, while bonds provide stability, and real estate grows steadily with urbanization. The 1920s, boom, speculation, and the crash. The 1920s are synonymous with rapid economic expansion in the United States, fueled by technological innovation, mass production, and consumer credit. The stock market reached unprecedented heights, reflecting widespread optimism. Equities stocks soared as investors chased gains in new industries like automobiles, electrical appliances, and entertainment. The Dow Jones Industrial Average tripled from 1921 to 1929. However, speculation was rampant. With many buying on margin bonds, bond prices were largely stable. With interest rates low, they were considered safe havens. However, corporate bonds linked to over-leveraged companies faced increased default risk. Urban real estate saw moderate gains, particularly in commercial properties and suburbs. Residential construction boomed due to population growth and mortgage availability. Commodity prices were volatile. Agricultural prices fell after World War I, causing distress among farmers. Industrial commodities, however, benefited from expanding manufacturing and urban demand. The crash of 1929, the speculative bubble burst dramatically. Equities lost nearly 90% of their value over 3 years. Bonds were largely stable, demonstrating their defensive qualities, while real estate declined slowly. Commodities experienced mixed results, with agricultural markets suffering the most. Key lesson: equities can generate tremendous growth, but are prone to speculative bubbles. Bonds and real estate can act as stabilizers during equity crashes, while commodities show varied resilience depending on supply and demand. The Great Depression and the 1930s, survival and stabilization. The 1930s were defined by the Great Depression, a period of extreme economic contraction. The world experienced massive unemployment, deflation, and widespread financial instability. Stock prices remained depressed throughout the decade, with some recovery only in the late 1930s. Long-term investors suffered severe losses, highlighting the risk of relying solely on equities for short-term wealth preservation. Government bonds, particularly U.S. Treasuries, became safe havens They offered security and modest returns, demonstrating their role as a defensive asset class. Municipal bonds, however, experienced defaults in some areas. Real estate property values declined, especially in urban centers with declining employment. Residential and commercial real estate were negatively impacted by deflation and credit contraction. Commodities, prices for industrial and agricultural commodities fell sharply. Farmers faced plummeting crop prices, causing widespread economic distress. Gold, however, maintained its value, foreshadowing its role as a hedge against financial uncertainty. Key lesson: the Great Depression highlighted the importance of diversification and the protective role of bonds and tangible assets like gold during systemic crises. Equities and real estate can remain depressed for years, emphasizing the need for long-term perspective. Post-World War II era economic boom and recovery, 1945-1970. Following World War II, global economies experienced rapid reconstruction, industrialization, and rising consumer demand. This period is often referred to as the golden age of capitalism. Equities, stock markets rebounded strongly as companies benefited from post-war consumer demand. The U.S. market experienced sustained growth, particularly in manufacturing, consumer goods, and technology sectors. Dividend-paying stocks became a preferred vehicle for long-term investors seeking both growth and income. Bond yields were modest but stable. Governments issued bonds to finance reconstruction and social programs. Inflation remained moderate, preserving bondholders' purchasing power. Real estate, the post-war housing boom transformed suburban landscapes. Mortgage programs like the GI Bill in the U.S. enabled millions to buy homes, causing residential real estate prices to soar. Commercial property also expanded alongside corporate growth. Commodities, industrial commodities such as steel, copper, and oil saw rising demand due to reconstruction and manufacturing. Agricultural commodities also recovered, supporting rural economies and food supply chains. Key lesson: economic booms benefit equities, real estate, and industrial commodities, while bonds remain stable. Government policy, such as mortgage programs or reconstruction financing, can dramatically influence asset class performance. The 1970s inflation, stagflation, and market volatility. The 1970s introduced a new challenge: high inflation combined with stagnant economic growth, or stagflation. Oil crises, geopolitical instability, and monetary policy missteps created a complex environment for all four asset classes. Equities. Stocks underperformed due to slow economic growth and high inflation eroding real returns. Price volatility increased dramatically, highlighting equities' vulnerability to macroeconomic shocks. Bonds. Bonds suffered as interest rates rose sharply to combat inflation. Long-term bondholders faced losses in purchasing power, showing that bonds are not immune to inflation. Real estate offered some protection against inflation, particularly in areas with rising population and demand. Commercial properties that could adjust rents fared better than fixed-income residential mortgages. Commodities, especially oil, gold, and industrial metals, soared in value. This era cemented commodities' role as an effective hedge against inflation. Gold's performance in particular demonstrated its status as a safe haven asset during periods of economic uncertainty. Key lesson: inflation dramatically alters asset class performance. Commodities provide protection, real estate can partially hedge, equities struggle, and fixed income suffers. Portfolio diversification is essential in unpredictable macroeconomic environments. The 1980s, 1990s, growth, deregulation, and the tech revolution. The late 20th century saw deregulation, globalization, and technological innovation. The U.S. stock market led global growth, fueled by computing, telecommunications, and energy sector expansion. Equities. Stocks experienced strong growth, particularly in technology, consumer goods, and emerging markets. Investor confidence returned after the recessions of the early 1980s, creating long bull markets. Bonds offered predictable income and performed well when interest rates gradually declined during the late 1980s. Inflation was under control, allowing fixed income to regain appeal. Real estate, urban real estate boomed in financial centers and growing suburban areas. Commercial properties benefited from corporate expansion, while residential markets expanded with population growth. Commodities, industrial commodities, experienced mixed performance. Oil stabilized after the volatility of the 1970s, while metals markets adjusted to globalization and technological changes. Agricultural commodities remained relatively stable. Key lesson: economic stability, technological innovation, and moderate inflation favor equities and real estate. Bonds regain appeal when interest rates fall. Commodities performance becomes more nuanced, tied to supply-demand cycles. The 2000s bubbles, crashes, and globalization. The early 2000s were dominated by the dot-com bubble and the 2008 global financial crisis. Markets became more interconnected globally, creating both opportunities and systemic risk. Equities, the dot-com bubble of 2000, illustrated how speculation can detach prices from fundamentals. After the bubble burst, equities recovered slowly, only to face another crash in 2008. Long-term investors in diversified portfolios benefited from eventual recovery, demonstrating the resilience of equities over decades. Bonds provided safety during crises, particularly U.S. Treasuries. However, ultra-low interest rates after 2008 reduced future return potential. Corporate bonds faced defaults, highlighting the importance of credit quality. Real estate, housing markets experienced a massive boom and bust cycle. The 2008 crash devastated real estate, showing its sensitivity to credit expansion, leverage, and speculative demand. Commodities, oil, and metals saw dramatic price swings, with peaks in 2008 followed by rapid declines. Commodities reflected global economic growth expectations and financial speculation. Key lesson: global interconnectedness amplifies both growth and risk. Equities and real estate are cyclical. Bonds offer protection and commodities remain volatile. Risk management and diversification are critical for long-term survival. The 2010s, 2020s, low interest rates, quantitative easing, and pandemic shocks. In the past decade, central banks implemented unprecedented policies: quantitative easing, ultra-low interest rates, and fiscal stimulus. COVID-19 pandemic introduced sudden shocks, testing all four asset classes simultaneously. Equities, tech stocks surged, while travel, hospitality, and energy experienced severe losses. The pandemic created extreme volatility, but also demonstrated the resilience of diversified equity portfolios. Bonds, ultra-low rates challenged traditional bond returns. Inflation in 2021 to 2022 highlighted the vulnerability of fixed income to real purchasing power erosion. Real estate, residential real estate boomed in many countries due to low rates and changing living patterns. Commercial real estate faced challenges from remote work and retail disruption. Commodities, oil, metals, and agricultural goods experienced sharp short-term swings. Inflationary pressures emphasized commodities' role as a hedge, though supply chain issues amplified volatility. Key lesson: modern markets are highly interconnected and influenced by central bank policy, technological disruption, and global crises. Asset class performance remains cyclical, reinforcing the value of diversification and historical perspective. Conclusion: lessons across a century. A century of market history demonstrates four critical truths about asset classes. No single asset dominates all eras. Stocks, bonds, real estate, and commodities each outperform at different times. Diversification is essential. Combining asset classes reduces volatility and improves long-term resilience. Economic context drives returns. Growth, inflation, credit expansion, and global events determine which asset classes thrive. Long-term perspective matters. Historical patterns reveal that crises, booms, and busts are temporary, while diversified, patient investors are rewarded over decades. Understanding the historical performance of these four asset classes allows students, historians, and financial enthusiasts to interpret markets with perspective rather than emotion. Equities reflect growth and innovation. Bonds reflect stability and security. Real estate reflects shelter and demographic shifts. Commodities reflect scarcity and civilization's raw needs. Together, they form the foundation of wealth preservation and growth across centuries. By studying history, we learn that markets are not random. They follow patterns influenced by human behavior, policy decisions, and technological progress. This knowledge equips learners to appreciate how asset classes interact, why diversification works, and how historical lessons can inform future financial decision-making. When analyzing financial markets, understanding risk, volatility, and correlation is as important, if not more so, than simply knowing which asset class historically delivered the highest returns. Over the past century, the four major asset classes, equities, bonds, real estate, and commodities, have each displayed unique patterns of risk and volatility. These characteristics determine how each behaves during economic booms, recessions, financial crises, and periods of stability. Examining correlations between these assets also provides critical insight into portfolio construction, diversification, and the historical dynamics that govern wealth preservation and growth. Equities, high volatility, high growth potential. Equities are arguably the most dynamic of the four asset classes. Stock prices fluctuate based on corporate earnings, macroeconomic indicators, investor sentiment, political events, technological breakthroughs, and global crises. Historically, equities have demonstrated high volatility, meaning their prices can swing dramatically in short periods. For example, the 1929 stock market crash wiped out nearly 90% of equity value for some investors. Similarly, the dot-com bubble in 2000 led to enormous losses in technology stocks, followed by a slow recovery. Conversely, during periods like the post-World War II economic boom or the 1990s tech-driven expansion, equities delivered exceptional long-term growth. This volatility is what gives equities their high growth potential. Investors who can tolerate short-term swings are often rewarded with superior returns over decades. However, volatility is not merely about daily price changes. It reflects the risk of permanent loss of capital if investors are forced to sell during downturns. History shows that patience and long-term perspective are crucial when investing in equities. Equities also display periods of extreme correlation with macroeconomic events. For instance, during global recessions, stock markets in multiple countries often decline simultaneously. During economic expansions, correlations may weaken, allowing some regions or sectors to outperform others. Understanding these patterns is key to managing equity risk over long horizons. Bonds, stability with sensitivity to interest rates. Bonds are often seen as the stabilizing force in a portfolio. Unlike equities, bonds generally provide predictable income through coupon payments and have lower price volatility. Historical analysis shows that government bonds, particularly U.S. Treasuries, have been the go-to safe asset during financial crises. For example, during the Great Depression, while equities collapsed, Treasury bonds provided relative safety and preserved capital. Similarly, during the 2008 financial crisis, bond prices surged as investors fled equities, demonstrating bonds' defensive role. However, bonds are not risk-free. They are sensitive to interest rate changes. When rates rise, bond prices fall. Inflation also erodes the purchasing power of fixed income, a phenomenon seen during the 1970s stagflation era, when rising prices reduced real returns from bonds. Credit risk is another factor. Corporate bonds can default, especially during economic contractions. Despite these risks, Bonds historically exhibit lower volatility than equities. They also have an inverse relationship with interest rates, which makes them particularly valuable during market downturns. When combined with stocks in a portfolio, bonds often reduce overall volatility and provide a buffer against equity drawdowns. Real estate, moderate volatility, localized risk. Real estate occupies a unique space among asset classes. It is tangible, illiquid, and location-specific, which differentiates its risk and volatility profile from equities and bonds. Historically, real estate prices move more slowly than stocks, but can be subject to cyclical downturns linked to credit availability, interest rates, and demographic shifts. For instance, the 2008 housing crisis revealed that excessive leverage and speculative buying can dramatically amplify risk. Homeowners and investors in overbuilt markets experienced sharp declines, while regions with stronger demand and lower leverage fared better. Similarly, during the post-World War II housing boom, suburban residential real estate appreciated steadily, benefiting from demographic tailwinds and government-backed mortgage programs. Real estate risk is often localized, meaning one city or region can suffer while another thrives. This contrasts with equities or bonds, which are more globally correlated. Furthermore, real estate generates income rent and provides inflation protection, which historically cushions volatility. However, it is less liquid than other asset classes, so investors must account for the potential difficulty of quickly converting property into cash during emergencies. Commodities, high volatility, inflation hedge. Commodities, which include gold, oil, agricultural products, and industrial metals, are often the most volatile asset class. Prices fluctuate based on supply-demand dynamics, geopolitical events, technological changes, and macroeconomic factors. Unlike equities, bonds, or real estate, commodities do not generate income, which makes their price swings more pronounced during periods of speculation or scarcity. Historical examples illustrate this volatility. During the 1970s oil crisis, crude oil prices quadrupled, causing economic turmoil and affecting equities and bonds worldwide. Similarly, gold surged during periods of economic uncertainty, such as the Great Depression and the 2008 financial crisis, reflecting its role as a safe haven asset. Agricultural commodities have experienced volatility due to weather events, trade disputes, and global population growth. Despite their risk, commodities historically provide an effective hedge against inflation. When currency purchasing power declines, tangible assets like gold, oil, and agricultural products retain or increase their value. This makes commodities a crucial component in historically informed diversification strategies. Understanding correlation across asset classes. Correlation measures how asset classes move in relation to each other. Historical analysis shows that equities and bonds often have negative or low correlation during crises, meaning bonds tend to rise when stocks fall. This dynamic makes bonds effective for risk reduction. Real estate's correlation with equities is moderate and varies depending on economic conditions. During credit booms, real estate and equities may move together, as seen during the 2000s housing bubble, whereas in other periods they behave independently. Commodities frequently have low or negative correlation with stocks and bonds, making them ideal for diversification during inflationary periods or geopolitical uncertainty. Understanding these correlations is critical because diversification is not just about holding different assets, it's about holding assets that respond differently to the same economic events. Historical data shows that a diversified portfolio of equities, bonds, real estate, and commodities typically exhibits lower overall volatility than portfolios concentrated in a single asset class volatility across economic cycles. Analyzing volatility over multiple economic cycles reveals predictable patterns. Expansionary periods, post-war booms, tech growth in the 1990s favor equities and real estate, while bonds may underperform due to rising interest rates, Recessions and crises, 1929 crash, 2008 financial crisis, COVID-19 pandemic favor bonds and commodities like gold, while equities and real estate often decline sharply. Inflationary periods, 1970s stagflation, reward commodities and real estate, while bonds and equities suffer. Deflationary periods, Great Depression, reward safe government bonds and gold, while equities and real estate decline. This cyclical nature of risk and volatility illustrates the importance of historical context when evaluating asset performance. Investors who ignore these cycles are more likely to experience unexpected losses. The role of portfolio construction. Historical analysis of risk, volatility, and correlation informs modern portfolio construction. By combining assets with different risk profiles and correlations, investors can reduce drawdowns, stabilize returns, and enhance long-term growth. For instance, equities provide growth and inflation protection. Bonds reduce volatility and preserve capital. Real estate provides moderate returns, inflation protection, and income. Commodities hedge against unexpected shocks and inflation. Historical backtesting shows that a portfolio blending these four asset classes tends to outperform single asset class strategies during both boom and bust periods. The key is understanding each asset's unique behavior, adjusting allocations over time, and maintaining discipline through volatility. Lessons from a century of volatility. High volatility assets can provide high returns but require patience. Equities and commodities swing dramatically, but over decades, they have historically rewarded long-term investors. Low volatility assets provide stability but lower growth. Bonds offer protection during downturns but lag in strong bull markets. Correlation changes over time. Assets that seem uncorrelated in one decade may move together in another due to systemic shocks, globalization, or policy changes. Diversification works, but timing and allocation matter. Simply holding multiple asset classes is insufficient. Allocations must reflect risk tolerance, time horizon, and macroeconomic conditions. Economic context dominates short-term performance. Understanding inflation, interest rates, and geopolitical risks is essential for interpreting volatility patterns. Conclusion. Over the past century, risk, volatility, and correlation have defined the behavior of equities, bonds, real estate, and commodities.
Equities offer high growth with high volatility. Bonds provide stability with interest rate sensitivity. Real estate combines moderate returns with location-specific risk, and commodities serve as a hedge against inflation and economic uncertainty. Historical analysis reveals that no asset class is consistently superior. Success comes from understanding how these assets behave individually, how they correlate with each other, and how they respond to macroeconomic cycles. Investors, students, and analysts can learn from these patterns to build more resilient portfolios and develop a long-term perspective on wealth creation by examining risk, volatility, and correlation across eras. We gain insight into not only financial markets, but the economic, political, and social forces that shape the world. History is not merely a record of past returns. It is a blueprint for understanding how human behavior, policy, and natural forces interact to influence the future of wealth. History is more than a record of what happened. It is a teacher for students, researchers, and aspiring investors. Studying the past performance of equities, bonds, real estate, and commodities provides lessons that extend beyond numbers. It offers insight into human behavior, economic cycles, the interplay of policy and markets, and the principles of risk and reward. While no one can predict the future with certainty, understanding history allows us to make informed, disciplined decisions, develop a long-term perspective, and appreciate the underlying forces shaping financial markets. Lesson 1: no single asset class dominates forever. One of the most consistent patterns over the last century is that no single asset class outperforms all others across every era.
Equities can deliver extraordinary long-term growth, but they are prone to crashes and extreme volatility. Bonds provide stability and predictable income, but they underperform during inflationary periods or when interest rates decline. Real estate can offer moderate returns, income, and inflation protection, but it is illiquid and location specific. Commodities can act as an inflation hedge or safe haven, yet they are highly cyclical and unpredictable. Historical examples illustrate this principle. During the 1920s, equities surged during the speculative boom, while bonds and real estate lagged in performance. During the Great Depression, equities and real estate collapsed, while U.S. Treasuries and gold preserved wealth. In the 1970s, commodities and real estate performed well during stagflation, while bonds suffered. The 2008 financial crisis highlighted bonds as stabilizers and equities and real estate as vulnerable to systemic shocks. The takeaway is clear: relying solely on a single asset class exposes investors to unnecessary risk. Diversification across multiple asset classes mitigates the chance of catastrophic losses and smooths returns over time. Lesson 2: diversification is essential. History repeatedly confirms that diversification is the cornerstone of prudent investing. By holding assets that behave differently under various economic conditions, investors can reduce portfolio volatility, preserve capital, and improve long-term risk-adjusted returns. For example, during the dot-com bubble burst in 2000, portfolios concentrated solely in technology stocks lost significant value, whereas diversified portfolios that included bonds, real estate, and commodities experienced smaller drawdowns. During the 1970s inflation crisis, commodities and real estate offset losses in bonds and equities, illustrating how diversification across risk profiles and correlation structures can protect wealth. Diversification is not just about quantity, it is about quality and correlation. Holding multiple equities, multiple bonds, or multiple real estate assets does not fully achieve the benefits of diversification. True diversification occurs when you combine assets that respond differently to the same economic shocks. Stocks, bonds, real estate, and commodities have historically exhibited this complementary behavior. Lesson 3: long-term perspective is critical. Financial history demonstrates that short-term volatility is inevitable, but long-term trends reward patience. Equities, real estate, bonds, and commodities each experience periods of rapid growth and sharp declines. The key lesson is that the ability to endure temporary losses and remain invested often outweighs attempts to time the market. Consider equities. Over the long term, the U.S. stock market has returned roughly 9 to 10% annually on average. Yet within decades, it has faced declines exceeding 50% during crises like the 1929 crash or the 2008 financial crisis. Investors who panicked and sold during these downturns often missed the recoveries that followed, which historically have been robust and sustained. Similarly, real estate requires a long-term horizon. Housing markets can stagnate or decline for years, but demographic growth and urbanization tend to drive appreciation over decades. Bonds, while stable, are influenced by interest rates, and commodities are cyclical. Patience, informed by historical patterns, is a consistent predictor of long-term financial success. Lesson 4: economic context shapes asset performance. The historical record shows that asset performance is closely linked to broader economic conditions: inflation, deflation, monetary policy, fiscal policy, technological progress, geopolitical events, and demographic trends all influence returns across asset classes. For instance, inflationary periods, 1970s, favored commodities and real estate, while fixed income and equities struggled. Deflationary periods, Great Depression, rewarded government bonds and gold, while equities and real estate suffered. Expansionary periods, post-WE, allowed equities and real estate to grow rapidly, while commodities experienced moderate gains. Understanding the context allows investors to set realistic expectations and construct portfolios that are resilient to varying economic scenarios. Historical analysis also underscores the danger of ignoring macroeconomic forces or assuming that past returns will automatically repeat under different conditions. Lesson 5. Correlation and risk management are key. History teaches us that correlation among asset classes changes over time, particularly during crises. Assets that appear uncorrelated in normal conditions can suddenly move together during systemic shocks. The 2008 global financial crisis is a prime example. Equities, real estate, and corporate bonds all declined simultaneously, challenging traditional diversification strategies. Government bonds and gold, however, rose, proving their role as hedges. Investors who relied on historical correlations without considering extreme scenarios experienced unexpected losses. This lesson emphasizes risk management. Allocations must consider both historical performance and potential future volatility. Stress testing portfolios against past crises and understanding correlation dynamics can help investors prepare for worst-case scenarios rather than relying solely on expected returns. Lesson 6. Inflation protection is critical. Inflation erodes purchasing power and can significantly alter real returns across asset classes. Historical periods such as the 1970s stagflation or the post-pandemic inflation surge demonstrate that equities, bonds, and cash holdings alone may fail to preserve wealth. Commodities, particularly precious metals like gold, and certain real estate investments often provide natural hedges. Equities can offer partial protection if companies have pricing power and the ability to pass costs on to consumers. Fixed income, especially long-term bonds, is particularly vulnerable to inflation unless indexed to inflation metrics. Historical analysis underscores the need for inflation-aware portfolio design, which balances growth potential with protection against purchasing power erosion. Lesson 7. Human behavior drives market cycles. History repeatedly shows that psychology is a major driver of asset class performance. Fear and greed influence buying and selling behavior, creating bubbles, crashes, and recoveries. The 1920s stock market bubble, the dot-com bubble, and the 2008 housing crisis all highlight how irrational exuberance can inflate asset prices beyond fundamentals. Conversely, panic during downturns can depress prices below intrinsic value. Understanding these behavioral patterns is as important as analyzing numbers. Investors who recognize the historical tendencies of human behavior can avoid common pitfalls and make rational decisions during volatile periods. Lesson 8. Diversification across geography matters. History also emphasizes that geographic diversification can enhance portfolio resilience. Economic, political, and social events often affect regions differently. For example, the U.S. stock market in 2008 declined sharply, while certain emerging markets experienced growth due to local factors and demand for commodities. Real estate markets in one country may stagnate while others boom. Commodities being globally traded provide an additional layer of geographic diversification. Globalization has increased interconnectivity, but localized diversification remains relevant. Understanding historical regional performance helps investors anticipate potential shocks and opportunities. Lesson 9. The importance of education over speculation. Perhaps the most enduring lesson from historical analysis is that education and understanding outperform speculation. Investors who approach markets with knowledge of historical performance, asset behavior, and risk factors are more likely to make disciplined decisions. Those who chase trends without context often suffer losses during inevitable corrections. Historical insight also teaches the value of record-keeping, research, and analytical frameworks. By studying past market cycles, investors gain a toolkit for interpreting future developments without relying on guesswork or emotions. Lesson 10. History as a guide, not a guarantee. Finally, history provides patterns, probabilities, and context, but never guarantees. While equities, bonds, real estate, and commodities have behaved consistently over the last century, future performance can diverge due to technological innovation, demographic shifts, climate change, geopolitical upheavals, or new financial instruments. The goal of historical analysis is not to predict exact returns, but to understand dynamics, risks, and correlations. This perspective fosters disciplined investment strategies, informed portfolio construction, and rational decision-making, lessons that are as valuable for students and researchers as they are for professional investors. Conclusion: applying historical lessons today. Over the last 100 years, the four major asset classes have revealed invaluable lessons about risk, volatility, diversification, economic sensitivity, human behavior, and long-term wealth creation. By studying history, we learn that no single asset dominates in every era. Diversification is crucial across asset classes, sectors, and geographies. Long-term perspective reduces the impact of volatility. Economic context shapes returns. Correlation among assets changes over time. Especially during crises, inflation protection is essential. Human behavior creates bubbles and crashes. Education and historical understanding outperform speculation. Ultimately, the study of financial history is not about memorizing numbers. It is about developing a mental model for how markets behave. These lessons guide investors, policymakers, students, and researchers in navigating complexity, making informed decisions, and appreciating the intricate interplay between human behavior and financial markets. History shows that while uncertainty is inevitable, knowledge, patience, and diversification provide the best tools for building, preserving, and understanding wealth. By integrating these lessons, we can approach financial markets with both curiosity and caution, recognizing that the past is a guide, not a guarantee, but one rich with insight for those willing to study it carefully.